Look at this. This is a simple USDJPY chart. Nothing out of ordinary. Now let's add an overlay on top of it. This is USDJPY with overlaid the US 10-year yield. So what is going on here? Why are these two the same thing pretty much? And who's following who? Is USDJPY following yields? Or are yields following USDJPY? Now, here's how it works. Capital, like matter, doesn't move randomly. It follows certain laws, like physics does. In the financial universe, the laws of physics is the bond market. Now I know what you're thinking. Bonds are boring. Wrong. Because its perceived boredom is the greatest piece of misdirection ever sold. So forget everything you think you know about bonds and follow me along in this video to finally understand how it all works.
Bond markets that persuaded you to reverse course?
I was watching the bond market that I saw last night where people were getting a little queasy. Bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful.
Okay, to really understand the bond market machine, you need to know it has two brains. First, you have the 2-year yield. Think of it as the market's tactical brain. It's fast, twitchy, and obsessed with what the central bank is going to do next. It's the purest red-on policy. In fact, as you can see from the chart, it is highly correlated with the Fed fund rate. And it actually leads the Fed fund rate. Because this is what the bond market does. It anticipates what's going to happen next. Then you have the 10-year yield. This is the strategic brain. It's slow, bigger picture, cares about short-term policy, sure, but it also pricing the whole economic story. Now in this video we're going to focus on the 10-year yield, since it's the most practical one to get a complete picture to implement in your trading strategy. Now listen to this very carefully. Is Treasury Secretary Scott Bessent talking about US yield some time ago?
I am curious. You talk about how you do look at the 10-year yield every single day. I love that. I love that you're the top bond salesman in the United States. And I'm wondering, are you expecting it or hoping it to go down from here?
Well, what's necessary are the underlying conditions. So the underlying conditions that we need for yields to come down. The 10 years come down, or rates have come down every week since Donald Trump's been president. So if we can continue that for 52 weeks, that'd be great. That'd be great.
Okay, with what you've seen so far in this video, with the relation between the 10-year yields and USDJPY that you've seen earlier, what do you think is going to happen to USDJPY if the US administration manages to actually bring yields down? It would go down because it would follow lower US yields, and that's the engine behind it. So you're starting to see how currencies are not isolated containers. The bond market is the transition mechanism. It's how a government's policy or a central bank's policy get converted into currency movements. Yields are the language that translates economic narratives into market dynamics. They are the live, breathing representation of what the biggest players in the world are doing. Now, how do you weaponize this? How do you use this to your advantage? Because that's what you want to know, I know. So first of all, you've seen already how correlated the 10-year yield is to USDJPY. And the same is true for NZDJPY, AUDJPY, CADJPY. All of these are highly correlated to US yields. Now I know, what do US yields have to do with NZDJPY? We're talking about the New Zealand dollar against the Japanese yen. Well, it's about risk sentiment and economic growth. If the 10-year yield in the US moves lower, that means the US economy is or is expected to slow down. And what happens when there's a bit of economic uncertainty? Funds move away from high beta currencies, such as the New Zealand dollar, and move where? They move into safe havens, such as the Japanese yen. So you can clearly see how yields pretty much dictate every Japanese yen pair. And similarly with the Swiss franc, but the correlation is way more evident on the yen. So that's the first way you can use this to your advantage. If US yields are likely to move lower because of growth concerns, because of rate cuts, because the US administration is telling you they want lower yields, whatever, then you can expect safe havens like the Japanese yen, Swiss franc, and gold to start doing well. Now the second way you can use yield to your advantage is to spot a divergence. You wait for the moment where two countries start telling two completely different stories. Let me walk you through a trade example. Let's say the UK inflation number comes in softer than expected. For the Bank of England, that's a reason to be dovish, so to potentially bring lower interest rates ahead. The market, which is extremely efficient, knows this instantly. And so UK bond yields fall on that soft CPI print right away. At the same time, across the pond, the Federal Reserve is on another note. They sound hawkish, talking about keeping rates higher for longer. And so what US yields do? They stay elevated, strong. In contrast, in stark contrast to UK yields that are going down. See what's going on here? A divergence, a clear fundamental signal. US yields are rising while UK yields are falling. You have two major economies on diverging paths, and the visual representation of it is their 10-year yields diverging. So knowing this, knowing the why behind the move, knowing that UK yields are falling because of soft inflation print in the UK, which is building the case for a rate cut from the Bank of England, and while instead the Federal Reserve is talking hawkish, where do you think GBPUSD should move? Now this is fundamental analysis. Now with that said, there's a critical exception to mention here, because this elegant machine of yields and flows only works in developed markets, or more precisely, in countries that are not at risk of defaulting. In risky, high inflation emerging markets, the rules are different. Take Turkey. They've hiked interest rates at a staggering 40%, and in fact, the bond yields look like this. By our logic, the currency should be a rocket ship, but with inflation at 64%, would you, a large investor, move your money there in Turkey? The risk of a currency's collapse and the risk of a country's default, it all heavily awaits the yield that you would receive. And so despite the sky-high interest rates, the currency has done this. So remember this very important exception. It's a reminder that a high-yielding country and a currency is attractive only when it's accompanied by stability. Higher yields due to a country having to hike rates unsustainable because inflation got out of control, that's not a good thing for the currency. So this rule is the difference between a high yield due to strength and confidence in a country's economy and a high yield due to higher risk premium demanded by investors. So in simple, higher rates and so higher yields are attractive for investors only when they are accompanied by confidence in the country in question. This is a very important difference that marks the difference between emerging markets currencies and developed market ones. So let's bring this together. Official interest rate change only at scheduled meetings. Yields, instead, move every single day. They are the live, breathing representation of what the market expects to happen next. They price in everything. Is the economy growing or shrinking? Are rate hikes coming or are rate cuts on the table? All of that is baked into bond yields. When that number is rising because of economic strength, the currency gets more attractive. When that number is falling because of slower economic growth, the currency gets less attractive, and money flows to safe havens like the Swiss franc, the Japanese yen, and gold, which thrive in an environment for slow recessionary growth and rate cuts. So with all this said, if you made it through this point of the video, I know this was a short one, but very packed of important information. I hope you learned something new. Let me know in the comments below, and subscribe for more educational videos about fundamental analysis that go beyond the boring, useless textbook definitions.